So in this problem, we're going to look at a company that is acquiring a machine, but they're not paying for it until 7 or let's see, I think it's 8 years after they acquire it. So when we're doing an acquisition for any operating asset, what we have to do is make sure we're measuring it properly, that the asset account contains the value that really is the amount that we're buying it for. So let's just take a look at the details of this one. And what we do is we click on this icon that basically gives us our financing information. So they are getting this item. It's a non-interest bearing note payable. So we don't have to pay any interest for 8 years. And at the end of the 8th year, we pay $880,000. But I mean, we're getting the machine for 8 full years. So just think about this. If you don't have to pay for 8 years, what are you paying when you pay back that 880? You're paying the principal plus interest. There's no such thing as no interest when it comes to accounting. So even though it might be labeled as a non-interest bearing note, GAAP requires us to figure out what the interest really is. So you can't just make a contract and say, oh, we don't pay interest. No, GAAP says you got to record this properly so that the machine is at the correct amount. And part of that is just think about it. The machine's going to be depreciated. And so we want to show that the depreciation expense each year is appropriate. And then the other part is interest expense needs to be properly shown also on the financials. So you can't just mix up and say, oh, I think it's just depreciation. No, it makes a big difference when it comes especially to our ratios and some other analysis. So to start with, what we're going to do is just to pick out the facts of this item. So we know that we're getting a machine and we're going to have to value it. We are going to have a note payable and we're going to have to go ahead and it's going to be 880. And what we're going to do is find the present value of that note. Okay. So what I'm going to do is now kind of show you what we're doing with Excel and how you would solve this problem. Okay. I have entered some of the values into these cells and we see future value after 8 full years. That's the amount that we have to pay on the note payable. The number of periods, of course, is 8. It's single compounding. They didn't say anything about annual, quarterly, or anything like that. So it's 8 years. And the interest rate was given. If we had done this from a commercial bank, it would have been 6%. Solving is what we want to do for present value. So what I'm going to do is go up here into formulas, and I'm going to go to financial, and I'm going to scroll down until I find PV. And I like the pop-up box because that makes my life easier. So I see rate and I'll just go click on that number. I'll put my cursor back into NPER, click on that number. Payment. How much payment do we have to make each year? Nothing, right? Payment is for an annuity and this is not an annuity. This is a lump sum. So I'm going to leave that blank. Future value is known. I'm going to plug that in. And then for type, that also has to do with annuities. I'm going to leave that blank. Now, one of the things I can do, because I don't like having negative numbers, I can go ahead and put a minus there, and that way it'll come out as a positive. Inflows, outflows, that's the way Excel looks at it. So when I do that, I get my amount of 552,123 if I round. And so what I'm going to do is now plug that in over in the problem. Okay, so I've gone ahead and I've shown that the machine is actually acquired for 552,123 when I round. And so debits have to equal credits. What are we going to do? We have what's called a contra liability account. It's called discount note payables. We're going to learn a lot more about discounts when we get to chapter 14. So from now, let's just worry about the initial entry and don't worry about what's going to happen over the term of the 8 years. So kind of look at it as interest that hasn't been incurred or paid yet. So that's our journal entry, and it's as simple as that.